All right, what's going on, everybody? Will Claus here, of course, from Davis R. Chant Realtors up at Lake Wallenpaupack. I wanted to start by kind of introducing myself. I can tell you a little bit more about how long I've been in business and all that sort of stuff, but it might just be easier to go to my webpage, will.realtor/about. Basically, I'm here today to talk you through the Lake Wallenpaupack, Wayne, and Pike County real estate market areas. If you're seeing this, it's probably because you've visited the area, or you maybe have a home up here, a second home, or just have friends and family that you've been up to before. So let me know a little bit more about yourself too. I'd be interested in getting introduced to you. This is my first time going live, so I'm streaming to Facebook on my personal page, on my business page, and on my YouTube page. So if you are tuning in on any of those, just leave me a comment. Let me know where you're from, that whole thing. So let me start here, see if I could pull this up on my screen share. I wanted to bring in my market update for 2021. This is a February update. And with this one, I hope to do this monthly. Basically, I'm going to start out with a lot of national data as well, because that's what we're seeing from our data aggregators. We have the most information from the National Association of Realtors, CoreLogic, Fannie Mae. There's some big time people that are just solely focused on real estate market nationally. So that's where I got a lot of these numbers from. But I also have been in the business for 12 years. I sell a bunch of real estate around Lake Wallenpaupack. I live in Tanglewood North, which if any of you remember skiing in the 70s, 80s, 90s, I'm on the old Tanglewood ski slope, which is actually maybe right behind me. You can't see with the windows blown out, but it's a cool little nostalgic area too. A lot of people seem to know this little ski hill in the middle of the Pocono Mountains. So I just wanted to get started here. Actually, my mom's calling me too. So the beauty of live video. This is let's see, my first slide here. Okay, so just a neat stat to start with. Existing home sales totaled 5.64 million in 2020. That's up 5.6% from 2019, and the most since the Great Recession. That number is actually super low for our local market area too. That's a national number. NAR is the National Association of Realtors, so that's what they're pulling that from. It's much larger in our area, and I'll show you here as we go. If you are getting my my postcards here sent to you, you'll start to see these statistics. These may look familiar. I did this at the start of January 2021. And at that time, we had 482 listings on the market, residential listings. As of today, February 23rd, there are 323 for sale, which means that we picked through 159 homes, which equates to about a third of our inventory, even just since the start of the year. So we're only about 6 or 7 months or 6 or 7 weeks into the start of the year, and we've gone through a third of our inventory. So that's going to make it a little bit difficult here to if you're searching for a home, but I anticipate, I'm looking out my window right now and I see about 20 some inches of snow still on the ground. It's snowing again, and it seems like it's actually snowed a couple inches today, which I don't even think made the forecast. Apparently 3 inches of snow isn't news anymore compared to how much snow we've been getting recently. So once people don't have to worry about plowing their driveways or heating their house, or people tracking muddy, snowy boots through their home, I think we're going to start to see more homes start to hit the market. If you look at what we have here on this slide next to me, look at the year-over-year changes. You see a lot of green there, and that's total listings that have sold. So that's not an increase in inventory. That's an increase in sales. That's year over year. And then, of course, in the median sale price. I like to use the median sale price so much more than the the average sale price, because it shows us a lot more. Basically, the median is where half the homes sold for more and half for less. This is what the National Association of Realtors use when they're giving their data. It's more relevant, I think, than average sale price, because it takes out that wide standard deviations of maybe some huge multi-million-dollar homes, and then of course some small homes that might sell for $10,000 or $20,000 that are basically teardowns. And even with that, we don't see too many $10,000 or $20,000 homes anymore, because the price of land is starting to increase as well. But if you look at these, some of these communities might sound familiar: Lake Wallenpaupack, Lakefront, That was pretty even, the amount of homes that we've sold, but the median sale price has gone up in just about every category except for the 500,000 and above. Basically, that 500 to a million did see a little bit of a slip in year-over-year change, but I don't think that necessarily means that prices crept down. I just think it was we were selling more of the lower end in that inventory. So this is 2020 versus 2019, and I can certainly start giving you some 2021 numbers now as we start to get into the year and get a little bit more data. Transactional forecast. So Fannie Mae, NAR, Mortgage Bankers Association here, they're all showing that we're probably going to have more homes sold even in 2021 than we did in 2020. And if you think about reasons for that, obviously COVID shut down our market from about mid-March until mid-May. So we lost 2 solid months of showing time. And then also that cut into our pipeline. Then our pipeline wasn't filled. So when we started to get back into showing, it still takes 4 to 6 to 2 months sometimes, depending on how backed up title companies and mortgage brokers are and underwriters to get our market moving again. 2021 home price forecaster projections showing an average of about 5%. Historically, the average has been 3.8%. So I think this 5% number is still incredibly low. It's going to be I'm anticipating that's going to be much more growth for our area, considering that these numbers are factoring in the entire country. So if we're seeing places like New York and markets that are more of the metropolitan markets that people want to get out of to get into more rural areas, it's taking their price losses into account as well. So Wayne and Pike County are definitely poised to be so much stronger. My personal professional opinion here, low inventory for that the 2020 market setup is really going to have effect on home values in a very positive way if you're a home seller, still going through 2021, and I anticipate for years to come. I've always been saying that our area is so undervalued, and I think the people that spent time here while they had to quarantine or while there was shutdowns in work and home life, they came up to their second home up here to escape. And it just seemed to be a perfect fit for people that didn't want to be too far, but within a 2.5 hour drive from New York, New Jersey, Philadelphia is a little bit further. And look at these mortgage rates. Freddie Mac, this is the 30-year fixed rate. You can see it hit a spike in 2018, but then fell way down. I'm on a text thread with a lot of other mortgage professionals, and they were joking today that 3% rate seems high, where before that was unheard of for mortgage rates. This quote really struck me too. It's by Mark Fleming, chief economist at First American, which is a title company. He said, rising interest rates reduce home buyer power and affordability, but, and this is a big but are often a sign of a strong economy, which increases home buyer demand. So even though rates may tick up right now because they are at just absolute historic lows, even if they tick up, it means that the economy is doing better and that people have their jobs back, they have a steady stream of income, they have more financial certainty, that they start to say, well, let's think about purchasing that second home or trading up, trading down, different home sales situations. So I think that the economy won't recover until housing recovers. So I think they'll keep those rates low. And then if they do tick up, it's probably a good sign for the jobs market and the national economy, probably the worldwide economy, actually. Mortgage rate projections. You're seeing that even up until 2022, maybe I think the highest number I see on here is 3.5% from Mortgage Bankers Association, MBA. So still plenty of great rates, and that increases your purchasing power, which I'll talk to you about in a little bit. Where will listings come from in 2021? That is a good question. I'm actually hoping it's from you if you're watching this and you have a home in Pike and Wayne County, because I'd be happy to talk that over with you. Again, I'll get into that later as well. Here's where listings will come from. Some people will feel comfortable listing their home during the first half of 2021. but others will wait until the vaccines are widely distributed. This suggests more inventory will be for sale in 2021 and into the spring selling season of 2022. So if you're a buyer, I've been telling all my buyers to be patient. This goes back to me talking about the snow. Right now, you're not going to see a ton of inventory on the market because it is going to be it's going to be something where we're at our usual trough in real estate. If you look at our curve, and I have a widget on my MLS that I see every day when I log in, and it always shows July and August is the peak of our inventory, which surprises some people. I think a lot of them assume that most of the inventory comes in the spring, and it starts to come up in the spring, but it isn't until July and August that we hit our peak, and that's obviously being a second home market for the summer. Lake Wallenpaupack being a huge draw. That's when people are up on vacations, the kids are out of school, so they can come up and actually start to sink in their teeth into looking at real estate. So as we move through, listings start to get picked through in the end of the summer. They start to close more in the fall. And then homes that haven't sold often expire on December 31st, just a firm date that they usually give their home until sell until. And if it doesn't happen by then, they pull it off the market so they can start it fresh again come spring. So I agree with this statement that more inventory will be for sale in late 20 and 21 because of COVID. And I'll talk about that in a few slides also. Month supply of available inventory. This is, again, a national number, and you could see that in December of 2020, we were down to 1.9 months supply of inventory, meaning that if no other homes came on the market, we would be completely sold out in 1.9 months. How do you calculate this? For the first, you find how many homes sold within the trailing 12 months, and then you see how much inventory is currently available. The local marketing time shows, again, I think it was 330 listings or so, and 3,500 have sold in the last 12 months. So that's showing 1.27 months of inventory. I calculated this maybe a week ago, and now today presenting it, I calculated it back down to 1.17 months of inventory. So it's a competitive market out there as a buyer, and sellers are really feeling the beauty of this type of market right now with low inventory. Note I wrote down here, low interest rates drove demand nationally, but COVID forced many people out of the cities into our area to buy or stay at their existing homes. So they either are buying their homes or they're saying, I'm not going to sell it right now because this has been such a lifesaver for us to have a spot to escape to where the quality of life is better, standard of living is a little cheaper, the air is fresher, and I really just love our pace of living in this area. So I think many people feel the same that are coming from more of the more populated areas. Total housing inventory at the end of December totaled 1.07 million units, which is down 16.4% from November and down 23% from a year ago. Unsold inventory sits at an all-time low, 1.9 months, or if you're looking at our local market, 1.17 months supply at the current sales pace. Looking at reasons why, going back to the work from home, in 2019, 6% of the population worked from home. In 2020, I think that this was at the end of 2020 that they calculated this, 21% worked from home. And that's not just 21% of office workers. I'm sure it's probably 80+% of office workers were working from home at least some point during the year. This factors in everybody. So people that are in service jobs, if they're in sanitation or if they're in the trades where they have to go to a house to build it, they can't work from home. But you'll see here that although this number will tick down a little bit, I anticipate for our area, I've been talking with people that said that their job is basically saying prepare to work from home for indefinitely, because we found that we don't need to have these big luxury office buildings. We just need a small space, maybe for a conference center or for small meetings, in person, face-to-face stuff, but you don't have to be coming in, sitting at your cubicle when you are fine to do that at home. I still think this is also, people may not consider working from home if they're just sitting on their couch with a laptop. The work from home that I'm seeing more and more people say that they're doing is they're converting a full basement area, or they're converting their loft or even a bedroom to office space. So that's the real work from home that we're seeing. When people said we used to want 3 bedrooms minimum, now they're saying we want 4 because we need that office space. Again, of course, this one is pretty obvious that new sales activity ran at a pace considerably ahead of 2019. Going back to this slide here, this number was from Lawrence Yun, chief economist for NAR. I'm pretty sure he was part of this panel, and great speaker, really brilliant guy. If you ever have a chance to look up any of his videos, he's definitely entertaining and super knowledgeable. So it just shows that people in our area that may not need to go into work, maybe they go in once a week or maybe even just twice a month now, they don't need that short commute, so they don't need to be right in the direct suburbs. They can move much more rural. Going on to 3 top reasons why homeowners didn't put their house on the market in 2020. The largest majority said life is too uncertain right now. I totally get that. You don't know if you're going to have the same job. You don't know where the kids are going to be going to school, if it's virtual or if they're going in person. Just a ton of unknowns. And obviously, when you have uncertainty and you have difficulty predicting, you don't want to make any major life changes like buying a home or, of course, selling your home. Financial uncertainty is different than the uncertain percentage of 34 people. So we're saying, looking at about 65 people are just uncertain right now. Financial uncertainty is a big one, as well as where their jobs may move to. If we're seeing a lot of people moving out of New York City, they might not have the same need for those in-person jobs that are out there. And then 25% said COVID-19 health concerns. And that is a big one that I would love to talk to you about. If you are considering selling your home, but are unsure about what the health screenings that we do, or how we can safely and with complete health consciousness in mind, sell your home in a manner that's not going to jeopardize your health and safety, give me a buzz. We can talk over what our new protocols are and how we can do that to make sure that your family is going to stay safe. Upon exit from the forbearance plan. Okay, so this is a big one that people were thinking. All these people are on mortgage forbearance. It keeps getting extended, so they keep falling behind on their mortgage payments, and that's not what the data is showing us. So if you look at what's been happening with mortgages lately, 28.6% made their monthly payment during the forbearance period. So that means nothing's changed in their mind. They just continued to pay their mortgage, didn't have any difficulty, didn't have to worry about struggling. And actually, about 51% are paid in full through different means, meaning that the 28.6%, they never had any change of making their payments. 7.5% paid off their loan, so they don't have to make any more payments. And 15.6% were past due, but brought it current then, maybe with a little bit more certainty or more flexibility in their ability to pay off their mortgage and get caught up. There's really only 15.3% that are still in trouble. And if you're one of those that are in trouble, again, you'll want to talk this over with a real estate professional. I'd be happy to talk it over with you as well to see what your options are. Because if you look at this blue section here, 7.5% did a loan modification. And the thing about loan modifications are you don't even have to be in trouble financially to get a loan modification. You can simply talk with your bank. If your bank still holds your loan in-house, maybe there was a portfolio loan or a savings and loan bank or trust, they can often be more flexible where they don't have to come back out and charge you all these fees. They don't have to come do an appraisal even. They may be able to just do a desktop appraisal and change your loan. We changed our loan from a 30-year, I think we bought it a couple of years ago, maybe at 3.75%. We dropped that down to a 20-year and are paying 2.75%. So we're actually paying less even though we took a decade off of our payments. So it's just a smart financial move. So I don't even think that 7.5% should be even in that risky area. 25.5% are doing the loan deferral right now. And that's kind of our wild card to see, are they going to get back on the green side or are they going to move to the red side? But even with 15 to 40% if you start putting in the other people, if you put in all the people that are doing loan deferrals right now, if none of them could get caught up. The thing is too, so many of them still have equity in their home and they have options. So instead of losing their home to foreclosure, they can still possibly sell their home, depending on when they bought it and how much equity they have. Maybe they took out another line of credit on it or something, but they can capitalize on the high pricing and low inventory right now, still sell their home and put some money in their pocket, even though they're behind and don't really have a plan. But most importantly, get a plan. That's going to be your biggest thing right now, moving forward. I don't think many, this is Lawrence Yun again, the guy I talked about earlier, who's the chief economist with National Association of Realtors. He said, given the huge price gains recently, I don't think many homes will go into foreclosure. I think homes will just be sold. And of course, that cash that's left over will be able to help make sellers' decisions easier. Affordability in today's real estate market. I talked about this earlier. You can see here in 2012 was probably our highest. And if the higher the index is, the more affordable it is. And we had a ton of distressed properties on the market. All those foreclosures hit. So affordability was very high. And even though if you look at today in the blue, even though there's less inventory and prices are higher, mortgage rates are really driving this affordability, making it actually more affordable than it was in plenty of years past to purchase a home because of the mortgage rates. Money is cheap right now. Percentage of income needed for mortgage payment is decreasing dramatically as mortgage rates fall. So you used to be able to, the historic norm was 21.2%. And now much less. Obviously, you can see it's just about a historic low. This is, again, how much income you'd need to commit to a mortgage payment. The typical mortgage payment, you can see that it's crept up, but you're getting more home for your money at this point as well. Here's my little puppy that came up to visit me. Once you include the equity benefit of price appreciation, owning made more financial sense than renting in 48 of the top 50 markets. That's something that we've said for such a long time. Of course, you have your anomalies like San Jose and San Francisco and outside of Silicon Valley where things are through the roof. So I think even renting out in an area like that, unless you're making seven figures, is a very difficult spot to live in. So I'm going to start wrapping up here. If you want to know more about this, if you want any copies of these slides, if you want any statistics or how this affects your situation or your local market, definitely reach out. Here is a spot that you can go to, connectwithwill.com, super easy. And there you can email me, call me, text me, follow me on any social media platform. Yes, I'm even on TikTok. I've actually just started Clubhouse as well, which isn't on here. So if you're on Clubhouse, give me a follow, send me a message. Would love to catch up with you and see how you're doing. And of course, if you were interested in getting either our monthly newsletter or our monthly mailers, get in touch with me, send me your address, and I can add that to your list so you can be updated with the market as it continues to change. Obviously, we're all watching this very closely to see what the spring and summer markets of 2021 are going to bring for us. And I'm here to help just be a consultant in your life and help you with your real estate decisions, help you make the right choice for you and your family. And I'm always accessible for questions should you have any along in the future. So thanks again, guys. My contact information is all listed at connectwithwill.com, and I look forward to hearing with you. Now let me see if I can end the broadcast here. Thanks again.